Thank you very much, Chairman, and thank you to Molly Scott-Cato for inviting me here today. I'm going to focus my comments on the banking sector and the role of monetary policy and financial regulation, which is the area of my expertise over the last 10 years working at the Institute for Innovation and Public Purpose and the New Economics Foundation in London. The first point I'd like to make really is the scale of the challenge we face. The Ashleg report, which has many excellent contributions, estimates 170 billion per year as the climate change financing gap, is absolutely enormous. This is a really serious challenge, and the report is quite correct in pointing out that it is not enough simply to rely upon the public sector to achieve this challenge. We have to mobilise the financial sector. But within the financial sector, there are more than just one or two players. There are more than just capital markets, and Eric has outlined the key role that capital markets can play. But I think the first point just to make is that capital markets and governments, for that matter, when they spend or invest, they are spending or investing existing money, which means they are taking money from somewhere else in the economy before they spend it. In contrast, commercial banks and central banks, when they spend, are able to create new money, new purchasing power in the act of lending, the act of credit creation being a much more appropriate term for this, because when you lend, you're giving up something when you make a loan. So banks create credit. They create around 97% of all new money in the economy. And if we are going to face up to the scale of this transition, I think that has to be the central fact that we take notice of. Unfortunately, there's little evidence that the banking system as currently constructed is up to the task. This is partially because climate change is a complex process, the impacts of which are highly unpredictable. There's lots of non-linear dynamics involved in the potential changes, the potential for tipping points that create runaway feedback loops, permafrost melting, unleashing methane into the atmosphere. It's very hard to forecast these tipping points. And in a sense, that's not set up for traditional market analysis, who focus on a 1 to 5 year time frame, typically. They're ill-equipped to deal with these dynamics, and as has been made clear already by Michelle's comments, there's a systemic mispricing of these issues in the market. This is, as Nicholas Stern described it, the world's greatest market failure. Now, the question is, what do we do about that? I think many of the contributions in the Ashleg report are very welcome steps towards that. The taxonomy is going to be enormously helpful, I'm sure, and the actions suggested on ESG frameworks are also welcome. But for me, what's missing from the report is more attention to these structural issues around how we get the banking system to support the transition. I think the time to talk about voluntary disclosure around the carbon assets, the stranded assets that banks are holding, is drawing to a close. We do not have time anymore to rely upon voluntary disclosure. We've had very sophisticated ESG frameworks out there in the financial markets for many years, and they've been ignored by the large majority of the financial sector, with a few very important exceptions. And there's no reason to think that just because international regulators or central banks are now asking commercial banks to voluntarily disclose this kind of information, it will necessarily happen. So I think that has to be mandatory. These kinds of risks have to be now brought out into the open in a mandatory basis. But I think we need to go a bit further than that. One of the key lessons of the financial crisis was that the efficient markets hypothesis, the idea that if you leave markets to get on with it, they will make efficient optimizing choices, that is no longer credible. And it became absolutely clear that banks on their own if left to develop their own risk weights and their own measures of risk, are prone to speculative investments and bubbles. And hence a whole new form of regulatory policy was developed. It's called Macroprudential policy. Some central banks have a very clear mandate around this, such as the Bank of England. It's not quite the case in Europe. There's a separate body more in charge of this. But the point of macroprudential policy is to look at systemic risk rather than the individual risks of different banks. And one of the key areas that was identified after the crisis where there was systemic risk was in the real estate market. Prior to the crisis, if you tried to persuade central bankers to force banks to hold more capital against mortgages, the response would simply be, well, we don't know how much risk there really is out there. We can't really be sure it's a proper bubble. It's better to clean up the mess afterwards. That response now looks very problematic with the benefit of hindsight. The argument I would make is that climate change, the transition risk, poses exactly the same type of risk. It's a grand systemic risk, and it's not sufficient to rely on individual banks or even microprudential policy from regulators to address this kind of system-wide macroeconomic risk. Instead, what we need is preemptive intervention, which macroprudential policy is exactly designed to do. So, there's many examples now of central banks forcing banks to hold more capital against certain types of loans on a sectoral basis, real estate being the obvious one, but there's also loans to other financial corporations, which are seen to be, in a sense, speculative, not contributing to the real economy. And there's some evidence that this is working. In Switzerland, there does appear to be a strong correlation between the implementation of increased credit and a reduction in mortgage lending. For example, research has shown this. So I think the EU should be taking this, and the ECB should be taking this seriously, and they should be considering raising the amount of capital or other forms of credit guidance, as I would call it, to support green investment and to push back against the excessive fossil fuel investment that's currently going on and that's locking in, which is creating this carbon lock-in, in effect. Now, there are other ways of doing it rather than simply forcing banks to hold more capital based on risk weight. You could have things like counter-cyclical buffers, so that as there's a growth of lending to carbon-intensive sectors, more capital has to be held. And there's green credit allocation, which is green credit guidance policies that were very popular in the post-war period in Europe. In France, credit guidance was used for many years, quite successfully, to support strategic sectors of the economy. So essentially, you require a bank to have 30% of their balance sheet focused on priority sectors. India is doing this right at the moment with lending against renewable energy as part of their priority lending program that's implemented by the central bank. So I think it would be great if the action group plan would look at the green credit guidance. I think just to talk, the green supporting factor as the alternative, enabling banks to hold less capital against green loans, is rather more problematic. It's the right idea, but it's the wrong policy tool, because you are undermining financial stability potentially in your attempt to encourage greater credit flowing into the right parts of the economy. So I would be more in favour of the Brown penalising factor or proactive credit guidance. But I just want to finish by talking about monetary policy more broadly, and this was the most disappointing aspect of the report for me, is that the role of monetary policy was not really mentioned at all. Now, I think this is problematic in a number of ways. The most obvious way is that clearly the ECB is creating 60 billion euros every month at the moment, having a huge effect on the European economy. But unfortunately, sustainability criteria are not part of its criteria. The point I want to make about this is that market neutrality is not the same as sustainability or climate change neutrality. There's research by the London School of Economics that shows that the ECB's loan purchases have essentially been skewed in support of high carbon sectors. Now, this is partially because they are essentially buying bonds, corporate bonds, the CSPP program, which in itself discriminates against smaller firms that are likely to be those that are innovating in the green renewable energy sector. So I think this needs to be seriously addressed. And my call really to the ECB would be to take the lead on this issue. If they're encouraging banks to disclose their carbon risk, why doesn't the ECB step up to the plate and assess its own carbon risk on its own balance sheet, and also in regard to the collateral that it requires when it makes loans to banks? It would be setting an example to the rest of Europe, and I think that would be a really positive first step. Thank you.